Now let's look at how to treat the particular items. For benefits, they usually are composed of the value of output of the project as measured by the sale price, especially for exports, which have horizontal demand curves, or the project is small so that it does not affect the market equilibrium, or the effect on the market equilibrium is negligible. Here we want to include sales tax like GST because they represented a kind of willingness to pay. Alternatively, we can use consumer surplus due to this project created by this project, if appropriate. All benefits could include savings and costs, of value and of environmental benefits, of value of the reduction in environmental costs, external costs. For example, the project could be building a park in Douglas, this says, and the value of this benefit, the value of that may help improve the biodiversity. So the value of this biodiversity is the one item of benefit. Sometimes it can also include value of downstream employment created. And this actually depends on the underlying assumptions of the project. If, say, for example, your project is, you want to, the project you are evaluating is, say, a training programs that give unemployed workers IT training. Okay, then the benefit will be the downstream employment created. Okay, costs. Usually they are composed of wages, salaries, rent, cost of materials, cost of transport, and overheads that are incremental. That's incremental to the project. Environmental costs must also be included. And here, usually we don't include taxes, okay? Okay, let's look more closely at tax. So depending on the specific, depending on what kind of tax they are. So taxes in the form of sales tax or consumption tax like GST. If the project increases national output, then these taxes should be included because we are interested in people's willingness to pay. They actually represent they captures consumers' willingness to pay for the products that you produce. Okay, if the project involves a transfer of resources from other products to this project, then the project's output should be valued at the opportunity cost of production. So the cost of factors of production excluding taxes. Okay, so the easiest way is this. We might want to do is follow 1 rather than 2. Okay, some people may say, okay, want to follow 2, but let's follow 1. If the taxes are company tax, like payroll tax, superannuation, well, which is not really a tax, okay, the company pays for the employees, or other transfer payments. So these are not costs to the nation, but are transfers of income within the nation from one part of the society to another, and so are not included in the CBA analysis. Well, these items are certainly costs to the firm themselves, so will be included in the firm's NPV analysis. However, since for our purpose, for CBA, we are standing at the society's point of view. So these items are actually not true societal costs, but they are a distribution of benefits of the project by the government. Okay, redistribution within the society is not incremental to the society. Sometimes we have government charges versus taxes. Now, if the charge which is imposed by the government or one of its agencies for a good or service, and it must be paid in order to obtain access to the resource, and the charge reflects the true economic costs of providing the resources. So now this charge is not tax, it's a kind of price to access the resources. Okay, so in such case, we should include it as an item of cost in the CBA, in the cost-benefit analysis. An example would be access to national parks, charges on noise pollution by aircraft, railway tickets. So these are charged that you got to pay in order to access a particular resources. So when the project you are evaluating involves such kind of items, you need to include them as one item of costs. Okay, costs can include physical inputs. If supplies have no alternative use, that is, they are not diverted from the market, then they should be valued at the cost of producing them, cost net of taxes. Let's say I want to implement or I want to build a bridge on Ross River. Okay, so suppose to build a bridge, I need a very unique truck, not the general trucks. So this truck, there's no market for it. Okay, so it can only be used in my specific project here. So now the cost of these trucks, these unit trucks, special trucks, would be the cost of producing them, and the cost of producing them, we do not want to include the taxes. Okay, that the manufacturers may need to pay in order to produce this unique truck, this special trucks. If instead these trucks are the general truck like we see in the market, okay, now they are diverted from market into my dam projects. So in such cases, we should value this cost at the market price, okay, which generally including taxes or subsidies. Okay, for example, in the market, the price of a truck is $50,000. Then we need to, because the truck, this general truck, let's call it, not the special trucks as I mentioned before, but these general trucks are diverted from market, so the cost will be $50,000 times the 2 trucks, so it's $100,000. Okay, so for a project, usually involved financing from somewhere, borrowing from bank, issuing equities, stock in the stock market, or issuing debt in the debt market. And there's financing costs, financing charges associated with doing so. Like you got to pay interest to if you borrow from bank, you got to pay interest for the loan you have. How to deal with this? Okay, these are all costs associated with financing the project, like interest payable, dividend payables, legal expenses, advertising, administration of the float or issue. They themselves are not considered as items of costs in our NPV calculation, but we do include the cost associated with financing. The cost of financing, this cost, they reflects time preference and risks associated with the project. How do we deal with NCBA? We deal with it by the discount rate. We choose an appropriate discount rate to capture all this. And in topic 8, we will talk more about how to select discount rate, what kind of discount rate we should use. So if we put this list of financial charges as items of costs, then effectively we are double counting them. Okay. Capital items. These are normally recorded as being committed at the time of purchase and at their total purchase price. How the item is paid for is irrelevant because it's the commitment of the physical item to the project is important. So the commitment of the physical items. And you want to record the costs, the dollar values at the time of commitment. Accounting depreciation. This is a financial device used for accounting or tax purposes. Important sense, it does not represent a flow of resources. So this sort of accounting depreciation, they do not carry a resource flows. Okay, it's purely accounting device we used frequently for tax purposes. So we do not include them in cost-benefit analysis. However, you might argue that, okay, I committed my trucks for the dam project. In the beginning, I put in a brand new trucks. When the project finished, I still got a truck back, but it's old now. It's used. So there's indeed an economic depreciation. Okay, it is defined as the decline in market value of this asset, of these trucks, over its period of use. So we need to account for this in CBA. How do we do that? This is taken into account by including the purchase value. So say 5 years. And at time 0, this purchase value say $50,000 of the trucks. I put in this recorded as cost. So negative, let's say, is cost. Then when the project's finished, in 5 years' time, it's released. The truck is released. So there's scrap value or salvage values of the trucks. Suppose it's now say 10,000. So now it's a benefit, $10,000 benefit we record at the end of the project. Okay. So the difference between 50 and 10 here captures the economic depreciation associated with the asset, the truck. Allowances for bad debts or taxations. These are same as a depreciation. Again, they do not carry resource flows, so we ignore them. Working capital. These are resources put into the projects at the beginning and released at the end. For example, cash. So this 5-year project. Initially, I put in $50,000, and in the end, let me put a negative sign because it's a cost. In the beginning, I committed this $50,000 in the beginning. Then in the end, this $50,000, when the project is finished, this $50,000 is released from the project, so I get a $50,000 back. So now that's how we capture these working capitals. And you should know that now there's actually cost associated with this. Okay, in the beginning is 50, so this $50,000 is present value. At the end of the project, in 5 years' time, it's still $50,000, but it's $50,000 in 5 years' time. We got to discount it back. Okay, so the present value of this $50,000 at the end of 5 years is not the same as the $50,000 in present times. Okay, this is how we capture working capitals in CPA. Land, we should value it at its opportunity cost. So if we purchase a piece of land for a project, then it should be valued at the purchase price. So that's easy to calculate. If we already own the land and committed the land for a project, then it should be valued at its opportunity cost, which is sale price. We should think if we do not use this land for this project, we can sell in the market. What's the price we can sell it? And that price, say $1 million, that's the cost, opportunity cost of this land. So when the project's ended, when we finish the projects, then we get the land back. Okay, the land is released, suppose, from the project. Then the land can be sold or used for other purpose. Now there's a scrap value associated with this land. So it should be shown as a benefit equal to its sale price at the time, or its value in the other use. If for some reason there's no alternative use for land, or you cannot use it for any other purpose, then it's just zero opportunity cost. Right, salvage or scrap value of resources used. This includes sale of plant and equipment, land, release of working capital at the end of projects. So these are the resources that were tied up but now returned to the economy. So the benefit will be scrap value, which occurred at the end of the project, say 20 years. So that's scrap value. Then discounted back to present time by this formula. Okay, external benefits and costs, such as improvement or deterioration of the environment, loss of irreplaceable resources. In CBA, we should include these items in our NPV calculations. And if this is an item of external benefit, we should use maximum. We should value them as maximum amount people are willing to pay for this benefit. If it is an item of costs, then we should value it at the minimum amount people or consumers are prepared to accept, or minimum amount to produce them. Generally, there's a difficulty here. Later on, I think in topic 6, we will talk about a number of techniques that we can use to value these external benefits and the costs. Inflation. Okay, usually a project involves many years, 20 years, 30 years. So, not surprisingly, there will be inflation over this 30 years period. How do we handle this? Okay, calculations of NPVs can be done using either all nominal or all real values. In practice, we might not have a choice, but if we do, we usually want to use real values. Okay, but more frequently, actually, we are going to have these nominal values. So we can work entirely in nominal values, including using an expected inflation affected discount rate. So we can use a nominal discount rate, which captures the inflation in it. Or we can work entirely in real values. So now we want to converting nominal discount rate to real discount rate by using what we call Fisher's equation. So if you have done B133, there we might talk about the real interest rate or real discount rate for our purpose, and nominal interest rate. And inflation rate. This is called real discount rate R, nominal interest rate I, inflation rate pi. And there we're going to say in B133, we're going to say real interest rate or real discount rate for our purpose is equal to nominal rate minus inflation rate. Okay, but here you want to be aware that this is only approximate. It's not accurate, or actually it's not correct, I would say. Accurately, we should use this Fisher equation to convert the nominal interest rate to the real interest rate, a nominal discount rate to the real discount rate. By the way, the interest rate that we observed in our daily life are usually nominal rate unless it's specifically said that it's real rate. For example, if you go to bank, borrow from bank charge you an interest rate of 8%. This 8% is a nominal interest rate. Okay, what do I mean by Fisher equation? Let's say I have two periods, today and tomorrow. Today I have $1 in hand, and the price of milk, let's say, is $1 per liter. Okay, $1 per liter. So if I use this $1, I can purchase 1 liter of milk. Okay. Now let's say interest rate is I. So if I invest this $1, tomorrow I can get $1 times 1 plus I. So 1 plus I dollar back. And let's assume that inflation rate is pi. So today the price of milk is $1 per liter. Tomorrow the price of milk will be 1 plus I dollar. Or 1 plus pi dollar per liter. Okay, because of inflation of pi. Then tomorrow I have 1 plus I dollar in hand. I'm faced with a milk price of 1 plus pi dollar per liter. So using this 1 plus I dollar, I can purchase this many liters of milk. So it's 1 plus I divided by 1 plus pi liters of milk. So now let's look at this investment in real terms. Okay, nominal terms. In nominal terms, I invest $1 today. Tomorrow I get 1 plus I dollar back. In real terms means in terms of milk. That's a goods. Okay, so I'm essentially doing this. I invest 1 liter of milk today. Tomorrow I get 1 plus I over 1 plus pi liters of milk back. So the implied real interest rate will be equal to change your milk over 1 liter of milk, right? So divided the change of milk by 1. So change of milk is 1 plus I over 1 plus pi minus 1. And this is the Fisher equation. This is where does the Fisher equation comes from. So real discount rate or real interest rate is 1 plus I over 1 plus pi minus 1. Let's look at an example here. If the nominal interest rate is 15%, expected inflation rate is 10%. So what's the associated real interest rate? Plug this number into the Fisher equation. We get 4.545%. Okay, let's use the approximation. So real interest rate is approximately the nominal interest rate minus inflation rate, so which is 15% minus 10%, so it's equal to 5%. So you should see there's actually discrepancy here. So this formula, real discount rate, real interest rate, is approximately nominal rate minus inflation rate. It's just an approximation. Be aware of this point. Okay, let's keep going. So here's an examples of working entirely on real numbers, real variables, or working entirely on nominals. So suppose a project 3 years, the nominal net benefit of year 1 is 1.1, 1,100, 1,210, so on and so forth. The associated real terms, real benefits is 1,000, and discount them back by using the real discount rate. We get this. So that's the NPV. Similarly, discount them back using the nominal rate, which is 15%. Okay, we get this one, and they are the same. Be aware that the difference here is due to roundings. Okay. All right. The next item, downstream employment multiplier effects or income and the other secondary effects. Generally, it is assumed that full employment of resources, so there are no net downstream effects. Okay, so we ignore it. Or if the capital wasn't used in this project, it would be used elsewhere with the same downstream effect. Or downstream effect is just small. We can ignore them. Thus, these effects are usually ignored or assumed to be zero. However, for some projects, such as those that are designed to create employment, either directly or indirectly, the benefits from increasing employment must be taken into account. For example, a scheme to train people so that they will gain new jobs. Okay, because that's the purpose of this projects. So we cannot ignore these downstream effects in such case. All right, last items. Distribution or consequences of the project. If your project is small, it might well be likely that it does not have too severe distributional consequences, and you might be able to ignore them or discuss them briefly. However, if your project is big, for example, a project could be evaluate superannuation policies, and that certainly is going to have a substantial distributional effect on the society. So in such cases, one shortcoming of our CBA, we should say, is that when we are calculating the present value of net social benefits, it does not include such kind of distributional effect, distributional consequences explicitly. Okay. So to do so, usually the usual practice is we want to discuss such kind of effect, distributional consequences in our report. Okay. This is particularly important where there's a trade-off. If there's a trade-off between improved efficiency and worsening in the distribution of incomes. For example, the CBA shows that freeing of trade improves efficiency, but causes greater unemployment among the rural poor. So in such cases, we got to discuss this implication in our report.